Debt emerges as one of humanity's most enduring inventions, a mechanism that harnesses promises to generate wealth without the need for physical goods. Throughout history, it has shaped economies, influenced governance, and altered the lives of countless individuals, often serving as a tool for those in power to maintain control. Far from a mere exchange of resources, debt embodies the interplay between obligation and opportunity, where the act of borrowing today commits future labor or assets to repayment. This dynamic has not only financed grand endeavors, but also perpetuated cycles of inequality, as the burden of repayment disproportionately affects the vulnerable while enriching lenders. In the cradle of civilization, ancient societies grappled with debt's potential to disrupt social harmony. Mesopotamian rulers, overseeing agrarian economies reliant on seasonal harvests, documented loans on durable clay tablets, tracking obligations for grain or silver. Recognizing the risks, they instituted periodic amnesties known as jubilees, erasing accumulated debts to prevent widespread servitude and economic stagnation. Such measures reflected an understanding that unchecked borrowing could lead to societal collapse, as farmers ensnared in endless repayment might abandon fields, causing famines and unrest. Similarly, in biblical traditions, the concept of a jubilee year every half-century mandated the release of debts and return of lands, emphasizing restoration and equity. These practices stemmed from a view of debt as a temporary aid, not a perpetual chain, aimed at preserving community stability amid uncertainties like crop failures or invasions. As civilizations evolved, attitudes toward debt shifted, particularly in medieval Europe, where religious doctrines intersected with emerging commerce. The Catholic Church's prohibition on usury, demanding excessive returns on loans, arose from ethical concerns that profiting from others' needs exploited desperation. Yet, enterprising traders and financiers devised clever alternatives, framing advances as partnerships in ventures or delayed sales, thereby skirting ecclesiastical scrutiny. This ingenuity allowed credit to flow despite restrictions, fostering trade across continents. By the Renaissance, influential dynasties such as the Medici rose to prominence in Italian city-states, extending credit to monarchs and clergy alike. Their operations demonstrated debt's dual role, not only as a source of immediate funds, but as a means to secure alliances and influence policy decisions. For instance, a loan to a warring prince might yield territorial concessions or exclusive trading rights, illustrating how financial ties could underpin political dominance over generations. This approach decoupled military funding from immediate royal coffers, enabling sustained campaigns without exhausting reserves. The model's success prompted emulation. England's establishment of the Bank of England in 1694 centralized borrowing, allowing the government to issue notes against long-term loans. This shift transformed debt from sporadic royal pleas to a structural element of fiscal policy, where continuous rollover funded ongoing expenditures. Lenders, in turn, gained unprecedented security as states' taxing authority ensured repayments, creating a symbiotic relationship that bolstered both economic growth and imperial ambitions. Over time, this framework facilitated expansive warfare and colonization, with profound long-term effects. Nations could mobilize resources far beyond their current means, leading to territorial gains that opened new trade routes and resource extractions. However, the cycle often exacerbated inequalities. Conquered populations bore the costs through tribute or labor, while European creditors amassed fortunes. The human toll was evident in the lives of soldiers and settlers, many of whom enlisted or migrated under promises of land or pay financed by these debts, only to face hardships in distant frontiers. Moreover, as empires grew, the administrative burden of managing vast borrowings contributed to bureaucratic innovations, like standardized accounting, which laid groundwork for modern financial systems. Entering the industrial age of the 18th and 19th centuries, debt permeated broader society, fueling technological and infrastructural leaps. Entrepreneurs borrowed to construct railways and mills, drawing capital from bond markets in financial hubs like London and Paris. Workers, integral to this transformation, often found themselves in debt to company stores or for basic tools, mirroring the obligations of their employers. This integration extended to personal finances. As urban populations swelled, individuals increasingly relied on credit for housing and essentials, normalizing borrowing as a pathway to stability. The cause and effect was clear. Industrial expansion created jobs but also dependencies, where wage stagnation prompted further loans, entrenching debt as a societal norm with lasting implications for class mobility. By the 20th century, debt evolved into a cornerstone of everyday life, particularly in advanced economies. Post-war prosperity in places like the United States saw the proliferation of home ownership through long-term mortgages, enabling families to build equity over decades. Yet, this accessibility came at a cost, as interest compounded, effectively doubling or tripling the home's value in payments. Consumer credit expanded similarly, with installment plans for appliances and vehicles, followed by credit cards that offered instant purchasing power. For many, these tools represented progress, allowing young couples to furnish homes or educate children, but they also masked underlying vulnerabilities, such as job insecurity that could turn manageable debts into overwhelming burdens. Internationally, mid-century institutions formalized debt's role in global relations. The 1944 Bretton Woods Conference birthed the International Monetary Fund and World Bank, ostensibly to promote reconstruction and development. In practice, their lending imposed conditions that reshaped borrower nations' policies, prioritizing creditor interests through austerity measures and privatizations. This mechanism ensured repayment, but often at the expense of local autonomy, leading to social upheavals like protests against reduced public services. Developing countries, borrowing to industrialize, frequently entered debt spirals, where servicing obligations diverted funds from education or health, perpetuating poverty cycles that affected generations. The latter half of the century witnessed financialization's ascent, where debt itself became a tradable asset. Institutions packaged loans into securities, distributing risks across investors and amplifying liquidity. This innovation spurred economic activity, but concealed fragilities as seen in the 1980s debt crises afflicting Latin America and Africa. Soaring interest rates triggered defaults, prompting interventions that extended more credit under stricter oversight, deepening dependencies. Individuals in these regions endured hyperinflation and unemployment, highlighting debt's human dimension, families displaced from farms or urban homes due to economic reforms dictated from afar. The 2008 global meltdown underscored these risks on a massive scale. Overextended housing loans, securitized and sold worldwide, collapsed when defaults surged, freezing credit markets and triggering recessions. Governments intervened with bailouts, prioritizing systemic stability over individual relief, which amplified public distrust. In the aftermath, policies like quantitative easing inflated debt levels further, ostensibly to stimulate recovery, but often benefiting asset holders, while ordinary people grappled with foreclosures and wage erosion. Today, global debt surpasses $300 trillion, dwarfing worldwide GDP and signaling an unprecedented reliance. This accumulation stems from persistent deficits, corporate leveraging, and household borrowing amid stagnant incomes. Long-term, it poses threats like inflation, erosion of savings, or potential sovereign defaults, yet it sustains apparent growth. The human element persists. Students burdened by education loans delay life milestones, while retirees face uncertain pensions tied to debt-financed funds. Looking ahead, innovations like central bank digital currencies promise streamlined transactions, but raise concerns about enhanced control. Programmable money could automate loan terms, potentially limiting borrower flexibility and amplifying creditor oversight. Historically, such advancements have favored those designing the systems, suggesting continuity in debt's power dynamics.